Good morning, everybody. It is Friday, May 21st, 2021. Investing 2020s with Kirk Spano, Seeking Alpha, Fundamental Trends, Blue Bond Asset Management over on Facebook and Twitter. So I hope everybody got a chance to take a look at the interview I did with Dr. Sean Stein-Smith from Lehman College, talking about Bitcoin, Ethereum, the flippening. The flippening is something that I think is real interesting. It's the idea that Ethereum will surpass Bitcoin. And I will tell you, back last summer, when I suggested that you put a single-digit percentage of your bank savings into Bitcoin, I would tell you now that you should break that up, sell most of your profits to begin with. I mean, I talked about that a couple months ago, but Bitcoin's going to have a big problem with adoption for transactions because central banks are going to compete with them, and there's going to be laws against it. China's already doing it. So Bitcoin really is going to have a limited market, and I think that gold, which has taken off lately, is probably going to come back into vogue. And we studied the ETF trends. I really have a hard time believing that Bitcoin is going to do anything more than chop around for a pretty long time. It'll get a bump if they have some ETFs come into play, but the reality is that if you're looking to preserve wealth and cash, you're just a bad investor to begin with. So you need to get your money into productive assets. Cash was never meant to be a productive asset. It's always been designed to be something as a medium of exchange. Yes, it's a unit of account, and to a certain extent, a short-term store of value, but it's not something that you're supposed to just hold cash forever with the idea that it'll be worth more in the future. Cash will always be worth less in the future, presuming we keep producing stuff and doing things. So I think that people need to watch this video and give it a probably twice through. An update on the webinars. I did update the schedule, so we're going to make these a little bit different. From here on out, we're just going to have a Monday afternoon and a Friday morning webinar, no Tuesday morning. But Monday is going to be a long session, basically broken up in 3 pieces: stocks of the week, retirement income options, and then swinging for the fences. And I'll try to do the swinging for the fences every week here going out, because I think there's some opportunities, particularly internationally, and that's where I want to jump off here, is get into the domestic picture on the market versus the international. And I know that there was an article this week by one of the Seeking Alpha authors who basically predicted a long-term depression. I'm just going to tell you right now that that's utter and complete bullshit. Because at this point, we basically have a solution for everything other than demographics. It's the only thing we don't have a solution for. So if you consider that the world really has a shortage of nothing, then you can surmise that we should be able to find a way to grow our way or increase standards of living, at least, out of almost any shorter term cyclical problem. So the idea that we're just going to have a monetary collapse, a financial collapse, a debt collapse, I think theoretically is silly. It is the viewpoint of an Austrian economist wannabe. I really can't make that any stronger anymore. I've talked about these Austrian economists with their neo views of how cycles work, the business cycle, and how it can't be overcome. You know, we've got 100 years of history that just screams out that they don't know what they're talking about. I mean, going all the way back to the Great Depression. The only thing that has caused cyclical downturns have been imbalances that were created by bad policy. And usually that bad policy comes with a vast deregulation and a skewing of the financial system towards smaller groups of people. We call that the 1% right now. And I've showed you the chart. over and over again that the problem is that the 1% have basically taken on all of the wealth that's been generated by the debt created since 1981. I've showed you the chart that once you have less money across the broad population and more money in the hands of very few people, that clogs up the system. And it doesn't really matter if the system is communist, socialist, or capitalist. Fewer people with most of the money, no matter how you get to that point, is bad. We're in a spot now where we're starting to undo the consolidation of wealth in fewer hands. And ultimately, as I've told you, there will need to be another bailout. There will be, because the retirement systems, health and pension around the world, particularly the biggest economies, Japan, China, United States, Europe, are all upside down. So much of this debt is owned by the actual debtors via their sovereign wealth that fixing the problem actually ends up not being terribly difficult. We just saw what happened with the pandemic. Print a bunch of money via quantitative easing, liquefy the economy, and then turn around and take that liquidity and spend it on building stuff and doing things. Stuff and things. As long as there's billions of people, there'll be plenty of stuff and things to do. Got a report from the IEA this week. Talked about the pathway to carbon neutral, what we had to do. Achieving that, whether it's on that time frame or not that time frame, a little fast, a little slow. I bet on a little slow. I'm hoping for a little fast. Means lots of stuff to build. Tear things down, build something new. There's never going to be a shortage of work until we reach utopia. Let me know when we get there. Biggest problem since the 70s inflation peak, so really the last 40 years, has been deflation. It's driven by demographics, complicated by technology. Why is that? There was a book written called More from Less about 2 years ago. The gist of it is that since the middle to late 70s, we have been able to supply more of everything using less inputs. The world has become more asset light, something that we've talked about over and over again. Best companies to invest in can create revenue and profits with fewer inputs. Scalable businesses, subscription revenue businesses, software revenue businesses, right? They build their money-making machine and it can just churn out money because adding customers takes very little in the way of input. When you have to make toilet paper, right, in one end, out the other. There's not a lot of margin to be created there. And even if volumes go up, it's not very much on a marginal basis. So when you listen to that again, you'll get the joke. Technology is still king. The problem right now is that valuations are exceedingly high. And when you consider profit margins, again, you have to think of the asset heavy, capital intensive versus the asset light, scalable. Companies where you have to put a lot in tend to run into problems when they have unexpected capital expenses. We need, as investors, to think about that very deeply and get away from the idea that you can out-speculate the professionals in futures markets, day trading, even most swing trading, unless you can find some sort of an edge through your experience, your knowledge, or whatever else you can figure out in a way that's faster than a network of supercomputers and cheaters. As I've told you before, I've been very intimately aware of how the hedge fund industry works for 16, 17, 18 years now. I was originally recruited as a quant a long time ago. I've done every form of technical analysis out there. What I keep coming back to is a very simple 4-pillar approach. I'm going to use the word pillar. Somebody use that in the chat. Can't use 4 steps. Somebody copyrighted that. So our 4-pillar approach, which is identify the secular trends, analyze government and central bank policy, take a look at industry and company fundamentals, and finally apply some basic technical analysis using longer term time frames in most cases, we can beat the heck out of the market. If you've taken a look at what we've done in the last 6 months, our risk adjusted returns have crushed the market, really. Take a look at all those premiums that we've generated. Take a look at the stocks that we've bought. Take a look at the gold stocks. Gold stocks alone, the last 6 months, have done very well. Right? They dipped down to 31. Now they're back to 39. And when we were talking about how low gold could go, gold stocks could go 6 months ago, what did we pinpoint? We pinpointed lower 30s. That's exactly what we hit. And for 3-4 weeks in a row, I told you, buy gold stocks. Sell cash secured puts on gold stocks. Now I'm telling you to do that with a particular company that is facing the asset heavy and the asset light worlds. We'll get to that in a second. Take a big look at the market though, because I don't think that people understand really why an analyst would come out and project a depression. I'm going to give you the number one reason. If he scares the hell out of you, you might subscribe. That's all there is to it. Elliott wave theory with their pinball analysis, I've been a part of it. There's nothing special about it. They're trying to get you to trade against professional traders, high-powered algorithms, technology that's way better than yours, and a network of cheaters. Just telling you, if you sit at a poker table and 3 of the other players are sharing information, you're toast in the long run. Might do all right for a while, but at some point, you're going to lose a lot of your money, if not all of it. Think about all these people who have been convinced to trade on margin here in the last couple of years. All the people who had money in Bitcoin recently. They call it an elevator style drop, right? Or an elevator drop, because it happens so fast and so deep. Top floor to the bottom floor, instant. A lot of people losing a lot of money. So I encourage you to reconsider whether you should be trading more or should be trading less. Because people who are trading more are missing 2 things. One, that when you do make a good stock pick, you end up missing tons of upside. They're trading too much. 2, when things fall, your technical analysis isn't going to matter. It's just not. The shorter term the time frame that you're using any type of technical or quantitative analysis, the less reliable it is. Why? Smaller data sets. The longer the time frame, bigger the data set, more accurate it is. Anybody who's an underwriter understands this. Small data sets applied to day trading and even swing trading aren't highly reliable data sets. But pretty pictures, scary talk, and pretend track records suck people in. All the evidence points to that. IRS shows stats every year that most traders lose money. And again, I'll use the poker analogy, but it could really be any professional sport or game. Because almost all the money is made by a single-digit percentage of the people. Then you have that group that floats around even, a low plus, a low minus, and everybody else loses and then quits. And you have to replenish that loser-quitter basket by sucking them in somehow. Told you about the Traders Expo I went to a little over 2 years ago in New York. Had some of the smartest people in the world there, economists, fundamental analysts, government people. They couldn't get 30 people in a room. What got people in the rooms was option trading, futures trading, and crypto. Sucking people in. I don't know when they're all going to get spit out. I know this. On a weekly basis, the S&P 500 is flirting with overbought. Doesn't mean it can't go up a little bit more. but we are way outside of either channel that you consider to be realistic. So you take this bottom point and make a parallel channel. I made two of them. The red is my base assumption. Purple is based on the argument that lower rates and higher valuations are forever. So you believe that interest rates stay low forever, that we're going to have valuations that are somewhere between 50% and 100% higher than normal, so up to double what they normally are, then the purple channel could be right. We're above that now. So pull back to this line is the middle 300s, and we talked about that a week or two ago. It's probably the least amount of downside we have. But seeing as we're in a Democratic regime again, which really isn't that much different than the Republicans, just marginally less bad. During this time frame under President Obama, Vice President Biden, we had QE to get out of a crisis, normal oil prices, normal regulation. Essentially, I'm calling it Clinton taxes too, similar. Then we had tapering. That's when we got that 2-year choppy period where the indexes didn't rise, but there were plenty of winners. We got into the Trump era, 5 luck, cheap oil. There was a brief tightening here, part of the post-tapering period. Lighter regulation, calling it George W. Bush taxes too. Then the repo market collapsed. I think it's important to talk about that. The light regulation with taxes that generally benefited the wealthy, that's what happened under President Bush, GW. We got the financial crisis. Well, the light regulation and the George W. Bush taxes too under President Trump basically helped crash the repo market, which kicked off $1 trillion of quantitative easing in 6 months, which is why the market continued to go up in late 2019, early 2020. Then the pandemic hit, we got the collapse. Then I'm just calling it QE plus. So we basically, in 1 year, done everything that we did since the financial crisis and then some. So imagine all the financial monetary policy for the financial crisis over a decade squeezed into 1 year. That's what we just witnessed. That's why this market went up like that. Liquidity speaks, sentiment listens. Ultimately, profitability speaks, sentiment listens. Technicals do not lead fundamentals. Fundamentals lead technicals. Where we don't have the ability to analyze the fundamentals, that's what the technical charts allow us to do, is discern what the fundamental story is underlying. And because people are chasers and momentum chasers in both directions, the technicals will overshoot the fundamentals. They lag, they go through equilibrium, then they overshoot in both directions. It happens over and over and over and over again. There's 100 books out there that you could buy to read about this. So when there's a change in direction of the technicals, right, it's the change of direction that matters. It pivots. That's where you get your biggest bang for the buck with technical analysis. This whole I'm going to ride the trend thing, okay, fine, ride the trend, and then go fishing. But day trading a trend is frankly, it's stupid. Because if the trend really is your friend, don't trade, ride the trend. The best way to ride a trend is get on near a top, get on near a bottom, get off near a top, or at least heavily trim. So you have money, buy down here. Elevator drop, massive stimulus, and now we're jitterbugging up here. Now, if we just hit a top, then your target correction range is probably down in here. So I believe that this is the more correct channel. The red lines are the more correct channel. Why do I say that? Because even within the red lines, valuations are high, historically speaking. But if the trend, secular trend, is that the whole economy is becoming more asset light because we use fewer inputs across everything now, right? Cars are lighter. We use less land to produce more food than we did 40 years ago. That's true. There's nothing really that's more capital intensive today than it was 40 years ago. Why? Science and technology. Building materials are lighter, made out of things that are recycled and not as scarce. Battery technology just keeps getting better and better. Use batteries for everything now. There's not a single industry out there that I can think of where the inputs required for the widget, for the output, is greater today than it was 40 years ago. So that is probably the underlying reason why valuations can actually stay a little bit higher than normal. Because more and more businesses, the CEOs aren't dumb. They might be greedy or evil. They're not dumb in most cases, are improving their businesses in ways that make them less capital intensive, even within capital intensive industries. Ultimately, that should lead to a normalization of interest rates. I don't know that I see it this decade, but eventually it'll happen. So somewhere within these two channels, going out to 2030, is where you should expect the market to normally be, S&P 500. I think the channel for QQQ will be better because those are some of the richest companies, a lot of technology, and generally more asset-light, less capital-intensive businesses. And those top 10 companies have 70% of the cash on all corporate balance sheets in America. I think you really should think that through. Your Google, Apple, Microsoft, etc. Just that basket of companies has 70% of the cash on all corporate balance sheets. So when people talk about how corporate balance sheets are better, it's not really true across the board. If you strip out the biggest companies with the most cash, then you look at the rest of the thousands of companies, you go, among S&P 500 companies and Russell 2000 companies that borrowed here during this last pandemic, during the pandemic, they've got more debt. So you have to make an evaluation on these companies about whether or not they're going to be able to grow enough in the next 4 or 5 years to be able to pay down that debt. A lot of the same ideas are international. Going in the India small cap chart, again, I put in two channels. What's the difference between America and India when it comes to demographics? India's demographics are much better. Also, they're much earlier in their S-curve for developing their economy in the United States. So while the upper band is possible in the United States, notice that the two bands still overlap quite a bit. Jump over to India, look at how much difference there is. Two bands, two channels, quite a bit further apart. Why? Again, youth of the economy, and youth of their populations. So while this chart could certainly come back down here, the question you have to ask is it returning to the channel that it belongs in, or is it overshooting? It actually does belong in this channel. Just like with companies, there's questions of execution at the national level. If India executes in general, if they do the things they're supposed to do to grow their economy, then I would argue this top channel is probably where you should expect these prices to be. If they don't execute, if they do bad things in government, or central bank screws up, then a return to this lower channel, the more bureaucratic channel, I would call it, because that really is the big problem in a lot of foreign countries, is their bureaucracies make ours look like there isn't one. So understand the wider range you deal with in international, which means that there's more risk, but clearly there's a ton more upside. So if this falls into this channel, somewhere in the low to middle 30s on this fund, India small cap fund, I think this is where you buy because you have a margin of safety, correct? You're well within the lower channel. You have a chance to jump up to the upper channel if that's where the future truly goes. It's how you build in a margin of safety with any investment. You take a look at the possible scenario outcomes. Okay, well, I could try to invest here, but I have to have a firm belief that I'm in the right channel. Or I can invest down here if it gets there and say, well, I'm either going to roughly break even or I got a bunch of upside. And that's what you want. You want a portfolio full of investments that really can't do much worse than break even or track a market, but also have a ton of upside. So our next chance to invest here, look at the jitterbug here, because I can't decide, on India would be, well, if it gets down to about here, I have to make a decision. Do I think this is as bad as it gets? Or am I only going to commit my money? Because remember, investing is like baseball, but you're not required to swing. If you could just take pitches in baseball with never getting called out on called strikes, you could just wait for the fat pitch. I'm dropping a lot of phrases that you've heard before. So you can wait for the fat pitch. There's one company I've been pounding on for a long time. Company that I told you is either going to monetize a gigantic asset or sell it, get something better out of it. So AT&T's merger this week, you got your handful of articles on Seeking Alpha and other places, and your people lamenting, oh, they're cutting my dividend. They're cutting my dividend. Yeah, you got your whiner babies that did that, and they're still doing it. They still do it with Kinder Morgan. Kinder Morgan's been going up for a couple years now, especially in the last year, for all the reasons that I've discussed about with that one, while it kicks out that big fat dividend. And at some point, Kinder Morgan's going to get bought or merge with somebody. AT&T has people out there writing about how bad the Time Warner transaction was. And I've told you all along, it really wasn't. But those people don't understand what they're talking about to begin with. They just keep running with it. Say something stupid, follow it up with something else stupid, because then at least you're consistent. Time Warner deal was fine for AT&T. Fine. Gave an interview here, talked about it. The CEO, he points out what AT&T put into that company, what they got coming out of it. And he doesn't even include the fact that they picked up all sorts of cellular subscribers because of the HBO deal. By my estimation, between 1 and 2 million subscribers. Cell services, which carries a lot of pricing power. So there's only 3 big companies in it, soon to be 4, if Dish executes. I wouldn't be surprised to see Dish just flip all of their spectrum if they're allowed to do that. But it sounds like they'll just be the 4th player in cellular soon. The 4 players in cellular, all the companies with similar expenses, similar capex, similar pockets, similar checkbooks, similar balance sheets, they're more likely as a group to collude and let prices drift up than compete on price competition. So in terms of how the deal with AT&T worked out, AT&T is basically getting half of their money back right now. They've already taken out billions of dollars. They've sold other assets that were part of that deal, and they get Discovery back, which presumably they're spinning off shareholders. I mean, if AT&T decided just to keep the 71% share of Discovery, I guess I'd be okay with that too. One way or another, I own it. If they spin it off, it's a gigantic dividend. Right? If they give us the shares, it's a gigantic dividend. I believe that AT&T is going to hold on to a minority portion of the company. On my reading of the documents, I can see them holding on to some percentage. We'll see. The companies that merged with Discovery a few years ago are doing it that way on that end. They're going to continue to hold parts of the company. In any case, the people who rip on the Time Warner deal, it's not a negative thing for them. The numbers don't say it. And they're still going to have a strategic relationship with Discovery. But if you take a look at what he says here, there will be a continued relationship with Discovery, so they can use that to get new clients for their cell services. But what did I say just on Monday? That they might become a platform company. Talks about right here, talking to other partners. We'll continue to do great business with each other and continue to distribute products on the media company's behalf. That won't necessarily be an exclusive relationship. Communications company will have an opportunity to think about other distribution relationships it might want to have going forward, sometimes in media, sometimes in other products and services. What does that sound like to you? What one word describes what the CEO of AT&T is talking about right now? What type of a company are they going to become? What are they going to offer? A what? Platform. Thank you. Come on, folks. If you're truly going to be an investor, think about what's important to a company. The whole point of our SWOT reports, so you understand the company in an 800-word capsule. AT&T is going to offer a platform. Like, who offers a platform for TV? What two companies are doing it? Amazon, kinda, and Roku. What do we know about business? Something's profitable with good margins, particularly something asset light, it'll draw competition. I mean, that's like the number one law of capitalism. Something proves itself in concept, it'll get competition. And just a week after those silly AT&T articles on Seeking Alpha about sell the company, I'm neutral on it now because, oh my God, they took some of our dividend. They're starting to get analyst upgrades. Well, your dividends only see this. Oh, you're betraying me, man. You're cutting my dividend. But if you take a look at some of these articles, one of the analysts actually says the company betrayed shareholders who believe they were told the company would protect its dividend at all costs. Think about that. How can you protect a dividend at all costs? Oh, that means you're committing to ruining the company to keep the dividend. Well, if the company's ruined, dividend goes away anyway, probably completely. Those sound a lot like Exxon. Exxon is in a world of hurt. Just telling you, if you own an oil company right now and it's not Total or Pioneer, you don't know what you're investing in. Total is pivoting to clean energy faster than any of the other ones, and they were a budget hound to begin with, cheapskate on properties and exploration. And Pioneer is the only company that's 100% in the Permian and has giant economies of scale and has the right infrastructure in place already. So, I think it's important that you think about all these big trends, about the way the world is going. And I threw out a relationship today that I think you need to think about. I will even, I think I put it in here in the chat. This book. Get time. Take 6 hours and read this book or listen to it. This idea of scarcity is one that I studied a long time ago, late 80s, early 90s. And I'll tell you, there is almost no scarcity on the planet Earth right now. Very few things that are scarce. Gold is scarce. They created Bitcoin to be scarce, mainly to launder money out of China, but to be scarce. So if the whole world is becoming more asset light, you want to be ahead of that. You've seen how software and technology stocks have done better than anything else for 20 years now. It's going to keep being that way. But the extension is going to be into all sorts of things that benefit from machine learning. Companies that can use technology well move more towards asset light, which is what AT&T kind of just did and is going to continue to do by becoming more of a platform company. Because after 2023, the CapEx requirements for AT&T drop, at least until we move to 6G, which won't be till the 2030s. What are some of the other things that AT&T have done to become asset light? Instead of building cell towers in the rural areas, they've contracted with a satellite company because they're hoping they can avoid all that CapEx, just have the satellite towers out in space. Solve for a problem of telemetry, and it works. Not guaranteed to work. Scientists usually get there if there's a way to get there. So I know that in most investors' heads, they're familiar with what they're familiar with. I would encourage you strongly that if you don't already buy into what I'm telling you right now, you need to reconsider. Because I'm not wrong. I'm not wrong about the economics. I'm not wrong about what's gone up. I'm not wrong about what's going to continue going up. I'm not wrong about oil collapsing again. Just mistimed that one. Didn't see such a giant rebound. But in a liquid market, hey, anything is possible. And what we know is that policy is shifting from monetary to fiscal. There's a giant mountain of capital out there. Governments are creating policies to force the people with the money to use it in a productive way. The government's just going to come take it away again. Gave you this money for nothing? Build something. Not going to build something, you got a problem. That's why they talk about just making the capital gains tax income tax. If they put an exemption in, it'll be for direct investment, right? Instead of in the secondary markets. They've done that before, right? We know that from history. So as the world shifts from monetary policy to fiscal policy, and it's happening all over the place, you have to consider what the market's going to look like as an investor. And the weird correlation that I've only really started to embrace the last couple of years, that scarcity isn't really a thing anymore. In the short term, we have some supply chain issues that have caused a temporary blip in inflation. By next year sometime, inflation rates will be back down to 2% or lower. Because the big trend in demographics dictates it. Technology fortifies it. What have I confused you with? What types of questions do you have? Well, so somebody says, how does one predict the timing? I'm going to give you two answers, and I'm going to go out of my normal bullshit range. Who the fuck cares? That's number one. Number two is nobody can do it. Nobody's ever been able to do it. That's why none of the billionaires are day traders. None of them. Not a one. You find me a billionaire trader, somebody who traded frequently. The greatest traders out there tell you they don't trade often. These very simple, longer-term indicators tell you that we're near the top of the market. If you keep sucking on that cigar, eventually you're going to burn your lips. If you're not accumulating cash into these rips and haven't been for the last couple of months, you're a bad investor. Fix it. Just like we should have bought a lot more down here, should be selling a lot up here. Unusually, it's hugged this area for a while. And that's because of the QE. I have cash targets for you. What type of investor are you? If you're retired and you can't stomach an elevator drop right now, and you know that the market is historically overvalued, I've showed those charts over and over again. I don't need to show them every week. You should be around half cash. You're closing on retirement, you're 40 or 50 years old, and you just want to make periodic cyclical trades, 20 to 40% in cash. Even if you fancy yourself a trader, you're still holding a lot of cash. And in reality, most traders actually do hold a lot of cash because they're in and out so often. But that's why they miss so much upside. Because they're out on those, you've seen the charts. You miss just a short period of time and you're screwed. So I've had to play some catch up. But I've been through this enough times, I know, well, okay, Don't lament the past, just deal with the future. And if you're frozen by paralysis because you think the end of the world is tomorrow, you miss a lot of upside. So what you should do is rotate from the high capex, asset heavy, into the asset light with less capex problems. AT&T transaction is an acknowledgement of that. I know that everybody wants an echo chamber. They want to be affirmed. And I get shot a lot because I'm the messenger. You need to get out of your shit old man stocks. And if you're in the camp of, AT&T's cutting my dividend, you're missing the point of why we were in it in the first place. I talked about them finding a way to monetize Time Warner for 3 years as I first got in. Because when it dropped on the Time Warner deal is when I bought. So one way or another, I knew that Time Warner wouldn't be worth less in the future. I had the opportunity to make a bunch of money with almost no risk. Price of AT&T has gone sideways for 3 years, chopped along, up a few bucks, down a few bucks. Meanwhile, I collected a 7% dividend while I waited for whatever was going to happen with Time Warner to happen. And now it's happened. And Time Warner merging with Discovery is more content. Understand this. Is more content than Netflix and Disney have combined. That's how big this merger is on the content side. And Discovery is huge and global. HBO's been pretty domestic. It's like Sirius buying Pandora and getting into the app space. Now Sirius can go global. Instead of being constrained by the satellites, it kept them to North America. AT&T, spinning off Time Warner, now makes Time Warner and HBO a lot more global. Remember, AT&T has Latin American assets, which I could see AT&T splitting off that company completely instead of just having it be a subsidiary. AT&T has the most fiber in America. That's a big deal because they can put right on the wire something that competes directly with Roku, and it's coming. So mark this. I'm telling you right now, I told you on Monday. I hinted on Monday. AT&T will have a Roku competitor in the not too distant future. And you'll be able to buy your apps right there. So in any case, understand the asset light is the way to go. You don't need to own a lot of things, which is why you can just be a bottom fisher. And I do think that if you're turning over your portfolio more than about 2 to 4 times per year, you're making the odds start to work against you. You got to be really good to do it 4 times a year. I mean, you really got to be a star. Flipping your portfolio twice a year is doable if you're really keeping up with those intermediate term cycles. But a lot of people, your bottom fishers in particular, might only flip over their portfolio on average every other year, every third year even, in normal times. And I do believe that we have some normalcy coming as we shift from monetary to fiscal. The thing is, that means a pullback is probably next. Then do you buy here or you wait to try to buy here? I'm starting to believe that we don't really get under 3,000 on the SP 500 again unless the Fed is told to stand down. That's the only way I can see it happening. Well, is the Fed told to stand down? In which case, the 2015-16 level, which I talked about for a long time, then that could happen. Then we get the Armageddon scenario. And so you got people out there talking about the Armageddon scenario. Why? That's what they like to talk about. They want more subscriptions. I'll tell you, I made all my money investing, all of it. And I've only got a few hundred subscribers and clients. I don't try to market that hard. I let people find me. I might change that. I've been flirting with that for a while now. Because I see people who didn't make their money investing getting rich selling investment letters. And they've never been registered or managed money, making money with investment letters. Kind of blows my mind. And the only reason a lot of trading services are doing well right now is because the Fed helped them do well. They're bull market managers, bull market investment letter writers, whatever, traders. The S&P 500 is out of the upper channel. It's going to come back. When it comes back, have your shopping list ready and have a plan for investing. The one thing that I could tell you that will probably make some sense is on the ETFs, be a bottom fisher. And on the stocks, scale in. Or vice versa. Scale in on the ETFs and be a bottom fisher on the stocks. Or mix it up. Bottom fisher on some, scale in on some of the others. Again, whatever's good for you. I mean, I'll tell you, the ETF trading is the one thing that I think is more predictable because the data sets are bigger. And right now, this one's screaming, we're jitterbugging the top right now. That means we're going to get a correction. Will this next correction be a 30% digger or 5 to 10%? Who knows? Liquidity is what's driving this for the moment. But I will throw something out there that's psychological. Most years from the end of June to August, market liquidity dries up because so many people taking vacation. And I think there might be an impact here from the reopen. Everybody's going to be doing stuff. Vegas is packed right now. Why I'm going 6 times in 13 months. As employment goes up and people coming out of the pandemic and they were stir crazy, I'm hoping that this is like 2010, 11, and 12 as things started to get better with the QE and jobs coming back. I made a ton of money those years gambling. And I think there's going to be less interest in the stock market this summer because people want to get the heck out of their house. I think that the summer slowdown that we usually get could be more pronounced this year. So if liquidity dries up, it means the correction could be like next month, starting next month, in July and August. And if the Fed talks about tapering, because 3 members brought it up in the last meeting, there you go. Now, I don't believe that Powell's going to taper. I think he wants to keep his job. We'll see. I think he loses the job either way. But he might not want to be known as the one that tapered. We'll see. We'll see. But I expect some correction. And I do believe that we'll be in these channels, probably within the red lines, which means that for index investors, people who don't pick out good from bad, more profitable from less profitable, better fundamentals from worse fundamentals, more growth, less growth, people who don't make good judgments, and they could see their index funds chop. Very little upside through 2030. So choosing to find the quality, understanding the businesses. I mean, I haven't found anybody who's given a better analysis of AT&T the last 3 years, and I look, because I'll steal it. If I find it, I'll steal it. So I'm telling you, the next thing for AT&T is to become a platform company and maybe to spin off international operations. So, all right. Bell and Chow, old cat that's no longer with me, and Bell, who just had her 12-and-a-half-year physical and is young as a puppy on the inside, apparently, say goodbye. Have a great weekend.